Hello everyone, welcome back to Upside Down Data. Today I want to talk about simulating returns when you use multiple UDPIs in concert with one another. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So if you've been following the channel, you may have seen some of our previous simulation videos. So for instance, I put out other videos where I've shown simulated returns just trading Bitcoin based on the UDPI. So if you had the UDPI running in real time, what kind of returns could you have expected trading based on it relative to a buy and hold strategy? And across the board, what I found is that it's been better. That if you had a UDPI and you had traded based on it, you can expect many multiples higher returns on investment than before. For example, if you started all the way back here in late 2011, the total returns you could have expected traded based on the UDPI is multiples higher than you would have gotten just buying back here and holding. Still would have been a lot of money buying and holding, but even more trading based on the UDPI output that would have been putting out in real time. But that's just one asset, right? Those simulations were just buying and selling Bitcoin based on UDPI level, but never putting that money elsewhere, never potentially branching out and investing in different coins in the crypto space. And that's what I want to talk about today. What would happen if you were trading between different assets based on their respective UDPI levels? So for example, if one asset pumps, the other one's still low risk, maybe you take profits off the one that's pumping, put it into the low risk asset and then pumps after that. It's this way of rebalancing your portfolio to try to capture the profits you're realizing in one asset and then compound those profits in the second asset that maybe hasn't made a move yet. That's what I want to talk about today. And I think this is an important topic because when we get these moments where the crypto space is really expanding, so for example, looking at the total crypto market cap here, this is just pulled off a trading view. When you get these big expansive moments in crypto, they tend to happen not everything pumps at once, right? You'll have certain assets that go first, and then other ones will follow later. And so it's staggered across time. It's not like everything is pumping and dumping at the exact same points. These bull runs, these bull moves tend to be staggered in what is pumping at one given point in time. And in that presents opportunity, right? Because if you are able to capture a big move to the upside on an early mover, and then take those profits, move it into a slower mover, one that hasn't pumped yet, you can basically compound your profits. You can take the whatever X you just made on the one that pumped, and then compound that again on whatever X that next asset then pumps afterwards. So this idea of rebalancing can help to increase the increase your gains, essentially. And so that's what I want to talk about. The UDPI offers a way of doing that, right? The UDPI will tell you if something is overheating and likely to correct. The UDPI will tell you if the asset is lower risk and hasn't necessarily pumped yet. And then you can use that to figure out where you should be putting your profits. You probably want to take it off of the high risk, put it into the low risk, for example. Not financial advice, of course, but that's just one way that you can use multiple different UDPIs. And I want to talk about this now because, if we were to get another one of these expansive moments again, I'm not saying that we're guaranteed to have that happen in the immediate future, but if it does happen, then I think we want to be prepared. And certainly the macro environment has not been bullish. I'm showing you here the S&P 500 index. It hasn't been particularly bullish at all. It's been the worst, January in a long time, the worst month for the stock market in quite a while. But just in the last day, we did see the S&P be able to break back above its 200-day moving average. Obviously, this is way too early to call anything, so I'm not saying we're about to see a bull market right now, or that the stock market's going to totally rebound, or that crypto is going to explode. I'm not calling that yet right now at all. But if the stock market were to be able to get more bullish or reclaim the 50-day moving average, for example, or start going back up, and if a more risk-on attitude takes back over, then it's possible that the crypto market could also see a move to the upside. And if that were to happen, we want to be prepared. We want to know what kind of strategies might be effective, what might work to try to maximize the profits we'll get. Because those moments don't happen all the time, right? These kind of moments are not all the time. And so when they happen, the idea is you want to be able to take advantage of them to the best of your abilities, is the idea I want to talk about here. So I want to show a couple different types of simulations I've been looking at these cross-asset strategies where you're taking profits from one, moving it into a lower risk other asset. When that one becomes high risk, moving that into a lower risk, etc. So to start off, I'm going to kind of keep it a little bit simple. I'm going to look at Bitcoin and Ethereum are going to be the two that I'm going to look at. But as I always do with these simulation videos, the first thing we have to establish is that the UDPI would be giving useful output in real time for whenever the simulation starts, right? This, what I'm showing you here, is a retrospective model in the sense that it has full knowledge of Bitcoin's history when it's estimating risk across the whole time. We want to make sure that it's able to do this in real time. And if you've seen our previous simulation videos, you know it can, right? Starting in late 2011, for example, if the UDPI for Bitcoin was made here, it would have accurately called risk for this entire time. So if you've seen that video, you already know that's the case. So for the simulation I'm going to show first, we're just going to start at the beginning of 2019. That's kind of arbitrarily the point I've decided to start from. And as I mentioned, we're going to be comparing Bitcoin and Ethereum. So this is what the Bitcoin UDPI looks like when it only has access to real-time price history. And what I mean by this is that this output, the way it's being generated is that the UDPI at this day knows all of Bitcoin's history before this day, but it knows nothing about Bitcoin's price action after that day. And then it's just recording the UDPI level at that day. And so hindsight bias is impossible. It doesn't know what's about to happen for Bitcoin. All it knows is about this day and everything that happened before. So it's as if you were running the UDPI in real time, basically. Then for the next day, it knows about that day and everything before, but nothing after, etc. And so for every single day that you see here, the level that's being recorded is the literal level it would have been giving you in real time. So if you had the UDPI at the beginning of 2020, it would have literally given you this UDPI score that's recorded here. So this is a simulated real-time UDPI output. And I like to use these in the simulations because this is as if you were doing this in real time. So if you had executed this strategy in real time, having these models, the results I'm going to show you are literally what would have happened. So that's why I like to use these. And it also just helps to validate the model to see how well it's able to call risk in real time like this. And the same for Ethereum. So this is, again, Ethereum being simulated in real time, again, giving useful risk readouts throughout this whole time. So let's move now into the simulation that I want to show. So the idea is we're going to be starting at the beginning of 2019 and then looking at trading strategy based on the UDPI and comparing it to a buy and hold strategy. So the strategy I'm going to be using based on the UDPI is a dollar cost averaging type of strategy. And dollar cost averaging just means that you're putting in money over time. And the reason you might do this is that you can kind of average in at these low risk points and get kind of the average kind of best cost basis. Then you average out over the top. You're not trying to catch the absolute top or bottom. You're just trying to average in towards the bottom, average out towards the top. That's the idea with the DCA strategy. And so essentially what we're going to do is we're just going to say based on UDPI level, if it's between any of these ranges, there's a different action that you'll do. You'll either buy if it's below 0 or sell if it's above 0. And then these are the amounts that I've chosen. So the starting cash is going to be $40,000, kind of arbitrarily chosen amount. And then I just kind of arbitrarily chose these as the DCA values. So $100 a day between negative 1, 0 or 0 and 1. And then, 200, 400, 800, 1600, just doubling as we go up. And again, one thing I should mention is I don't think this is the ideal strategy or the optimal strategy or anything like that. This is literally just something I just threw together. I was just like, sure, let's just try this, see what happens. So keep that in mind. This is not supposed to be the optimal strategy. It's just a strategy you could use. I think it would be up to you, if up to anyone who is developing a strategy, what they would think is best. I'm not trying to argue this is the strategy to use. It's just a strategy that could have been used. Okay, so this is the schedule we're going to be using, right? So it's just literally what is the UDPI level for the asset, and then based on that, you're going to do this. You're going to either sell this amount per day or buy this amount per day. And then the idea is that you're going to be monitoring both the Bitcoin and the Ethereum UDPI and executing based on their respective UDPI levels. So if one's negative, one's positive, you'd be selling the positive, buying the negative. If both are positive, you're selling both. Both are negative, you're selling each, and it's just based on the level, how much you're buying or selling. Okay, so what are we at? Let's look at the actual nuts and bolts of the comparison we're going to be doing here in these simulations. So the test strategy I'm going to be looking at, this is that weighted DCA strategy I just showed with that schedule that we just saw. One thing I'm going to do in this simulation is I'm going to multiply all of these values by 10 by the time we get to the top of the 2020 to 2021 bull run. The reason I'm doing that is just because you'd have a ton more money at that point than when you start. And so you would naturally be adjusting your DCA amounts up. So this is kind of just a kind of a rough, crude way of doing it, but it's just, I think it's fine. So, once we get up towards the top of the bull run, you're just increasing the DCA amounts because you have more money to play with. So that's how I'm doing it here. And also we're using the long-term UDPIs for this simulation. So these are ones that care about these moves that play out over months. And given that we're caring about a longer time frame, it seems reasonable to use the longer term UDPI. Might be one that you want to look at. You could do this with the shorter term ones. You could do it with a short term and the medium term. I'm just going to do it with the long term since we're looking at a longer period of time here. So the comparison strategy we're going to be looking at is this buy and hold strategy. And so this is literally you just, at the beginning of the simulation, this comparison person is just going to buy right then. They're just going to put all their money in, split evenly between Bitcoin and Ethereum, and then just see what their profits would be over the same time. So the setup is that the DCA person, so the person doing this weighted DCA strategy, they're going to start with $40 in cash, so they have nothing invested yet. They're going to invest based on what the UDPI tells them. The buy and hold person just buys $20,000 worth of both Bitcoin and Ethereum. And obviously we know in hindsight that doing this would have been great. Buying $20,000 worth of Bitcoin and Ethereum back in the beginning of 2019 would have been fantastic. Let's see if this DCA approach, this using the UDPI for Bitcoin and Ethereum and then trading between them, let's see if this can beat it. Let's see if this can do better than the buy and hold strategy across that same time period. Okay, so let's look at the results. So this is the white line here I'm showing you is the total value, the monetary value for that DCA person, so the weighted DCA person. So we can see is it's quite good, right? So if we're just looking at just the return here, not comparing it yet to the other strategy, you're starting off, these are $100,000 per one here. Starting off at 40,000, you're ending up at about 160,000 or so. I'll show the exact numbers in a minute. So pretty darn good, right? You are doing quite well. You're quite happy to turn $40,000 into 850,000. You had over $1 million back in November. Not bad. Let's compare this to the buy and hold. So that's what this orange line here. This is if you just bought and held $20,000 worth of Bitcoin and Ethereum. 20,000 Bitcoin, 20,000 Ethereum over the same period. We see you would have been doing worse. You would not have done as well as the weighted DCA strategy. The weighted DCA strategy outperformed over this time. And if we add some more to this chart, we can kind of get a better sense of what's going on in the simulation and how this weighted DCA strategy is able to outperform. So what this green line is that I'm showing you here, this is just the amount of cash that the weighted DCA person has on hand. So just cash out of the market that's not invested. And then the light blue line here is the dollar value of Bitcoin held by the weighted DCA person. So that's this one here. And then the pink is the value of the ETH that's held by that weighted DCA person. And so we can get a sense of what they're doing, what trades are being made. So the green line, they're quickly investing in. You see this green line go down to zero very quickly. So they're quickly buying in Bitcoin and Ethereum, building positions in both. They're going in later on in 2019 when we had that kind of bit of a bull run. There's some profit taking that's happening, and then it's just getting reinvested back in. And it looks like it might have been invested a little bit more into Ethereum here than Bitcoin. You can see the Bitcoin value dropping while Ethereum goes up. It's a little bit hard to know because this is sensitive to both the amount this person has and the price, but there's probably some mixing going on, some portfolio rebalancing based on relative risk at that time. And then for the most part, this is just kind of hanging out. They're just holding their positions. And then when we go into the parabolic phase, going into early 2021, this is where some trading really starts to happen, right? So as Bitcoin takes off first, kind of leads the way up, some profits start to get taken. And then as Ethereum follows up along as well, some profits are taken. So the Bitcoin position is getting sold out here. They're holding the Ethereum position a bit longer to really milk it for what it's worth. And look at all this profit they're generating through here, coming into that crash that we saw in the summer. The weighted DCA person was holding about, almost about $550,000 out of the market when that crash happened into the summer. So you can see they're just not hit by that downside very hard, right? So the buy and hold person gets slaughtered in the sell-off that happened in the summer of 2021, the weighted DCA person isn't hit nearly as hard because a lot of their money was taken out of the market already. They hadn't taken all of it out. There's still some amount of crypto they were still holding, but they've taken most of it out of the market at this point. So they're really insulated against that downside. But you'll see then they start to reinvest it because risk fell during the summer quite precipitously, both for Bitcoin and then Ethereum also dipped into the green zone. So you can see them buying back into the market. They're building up their Bitcoin position. They're building up their ETH positions again. And it looks like they're a little bit more heavy in Bitcoin than ETH for this next run. And then as things pumped again, they're taking profits again. Risk is going up. They're taking profits. So when we hit this more recent downside, they're again insulated from it. They're not hit as hard because they still have a good amount of money out of the market. They're back up to about $550,000 out of the market. And now it looks like they're reinvesting back in because the risk has fallen again. And so, as you project over time, you can imagine that if risk key stays low, those continue to invest in. But if we get return back to the upside, then all this reinvestment they've been doing will now appreciate into even more value. And so really over time, this can start stacking on top of itself, right? That all this extra money you have here is more money that you can put in to then ride further. And then you can just start kind of out compounding the buy and hold because you're able to lock in profits, then reinvest them later at more favorable times in the market. That's why this strategy is so powerful. It's because it allows you to lock in profits as they're attained in a pump, and then reinvest those profits at low risk points in the market again, so that you can then ride those profits up again, lock them in again, reinvest them, so on and so forth. So you can see that at the end here, the weighted DCA person has a total value of about 860,000, a little less, 857,000, compared to about 600,000 for the buy and hold. So buy and hold did quite well, obviously. They didn't do poorly, but they didn't do nearly as well as the weighted DCA persons. This is a 43% increase ROI, a 43% higher ROI, just trading between Bitcoin and Ethereum based on the UDPI levels relative to what you would have gotten if you bought and held. And again, I think this is impressive in a lot of ways because it is one thing that's important to know is that it's really hard to beat the market. It's really hard to beat a buy and hold strategy overall. Most people who try to develop strategies will end up underperforming if they just bought and held. You see this in the stock market oftentimes. There's a lot of research that shows that people who buy an index oftentimes will outperform people who try to use more active trading strategies. It's just really hard to do it because it's very easy to miss the timing, to not get things right. It's difficult. So the fact that UDPI can outperform the market, and by this much, 43%, is quite impressive in my opinion, especially during this kind of parabolic phase. It's able to navigate this very effectively, really lock in those profits, and then help compound them over time. And it's also important to note, this is only two assets, right? This is just Bitcoin and Ethereum trading between them, and you're able to beat a buy and hold by that much. What I want to look at next is a simulation where we expand the scope. Let's look at 4 assets trading in between them. So we're going to start at a bit of a different time. We're actually going to start the simulation at the beginning of June of 2021. The reason I'm doing this is I just want to use some other assets that just don't have nearly as much price history behind them, where the UDPI would need a lot more the data that's happened in here to train before they can start reliably. You'd want these models to start running. The UDPI needs some amount of data to train on before you want to set it free instead of have it run in real time. So these assets, the UDPIs, are best suited to start after they've been able to train on some of this earlier data that we saw here. So that's why I'm going to start this in the summer, where we got this other bull run. We'll be able to look at all these other ones here, and they all will have plenty of data to train on so that their simulated real-time UDPI is something that we can trust, we would want to rely on. Because again, with any model, you need to train it. I want to make sure these have enough data to train on before setting them loose. So that's the reason we're starting in June. And then the test strategy is going to be the same as what I showed you before, same schedule, etc. It's just now that we're looking at all of these together. And what I'm going to do is I'm going to multiply, again, those values by 3 after that September Bitcoin top. Again, the idea being that you suddenly have a lot more money on hand to play with. You'd want to increase the values that you're using in your DCA calculations. So just as a rough way of doing that, I'm just multiplying things by 3 once you get to that point in time. And also to note, I'm using the short-term UDPIs for this simulation. The reason being is that partly this is a much shorter period of time we're going to be looking at, just from last June to now, so not nearly as much time as from the beginning of 2021 all the way, or excuse me, beginning of 2019 to today. So I want to just capitalize more on that kind of shorter-term volatility. And the other reason I want to do this is that the short-term UDPI will be more volatile, will move to the upside and the downside more as price moves, as it's reacting more to that kind of shorter term price action. And I just want to give maximum opportunity for there to be these divergences in the UDPIs between different assets, right? Times when the one asset's UDPI is high and other ones are low, to really maximize the ability for this strategy to really trade between them and try to maximize that yield. So that's the other reason why I'm using the short term for this. So again, these are all the UDPI levels I'm using are ones that are simulated as if they were in real time. So it's basically as if you had these all starting in June 1st and then just had them run in real time, the exact values it would have been giving you. So nothing in here is retrospective, just for clarity. So the comparison strategy, again, just buy and hold. So the setup, again, $40,000 in cash to the DCA person, nothing's invested yet. And then the buy and hold person has $10,000 in each of the four. So same value to start off with, $40,000. This person's already positioned, this person isn't. Let's see how they compare to each other. Okay, so again, just going to show you the total value first of the DCA person. And we can see is that it's quite good. Just over the, kind of a little over half a year kind of performance, it goes from 40,000 up to over 120,000. Up almost all the way to 160,000 here at the absolute top back here. Actually, in January, we'll get to this in a minute. It's interesting that it peaks in January. That's not when the market peaked, and this is something we're going to talk about here in a minute. So how does this compare to the buy and hold strategy? Well, it slaughters it. It kills it. Look at this. The buy and hold strategy would have gotten, its overall return would have been 40,000 to around 60,000, a little less. So only about a 50% increase, whereas the weighted DCA strategy across the four assets is over 3x higher at this point in time. And so weighted DCA strategy is blowing out the buy and hold. The UDPI-based strategy is killing the buy and hold strategy. And if we show these other lines, we can start to see how this happens. So again, the green line is the amount of cash on hand for the weighted DCA person. The light blue is, again, the Bitcoin held value in dollars. The pink is Engine Coin. So I should have mentioned the four assets we're looking at. So Engine Coin is another one that I have in here. Atom is another one here, Cosmos, and then Helium is the last one. And the reason I chose these four assets, if you're curious, is that they're from kind of different sectors of the crypto market, right? Bitcoin kind of being the king, kind of the store of value representative here. Engine Coin kind of being the more gaming metaverse representative. Atom being kind of the layer one up and comer or challenger to Ethereum. That's what this is representing. And then Helium being this kind of utility token, the decentralized, Helium being a decentralized wireless network, basically. That's what this is representing. So kind of a more utility token. And the idea is that these should be more decorrelated with each other than some others. Like if you just did all layer ones, they'd probably be kind of more or less pumping and dumping at similar times. There'd be less of that divergence between them. I'm going to choose ones from different sectors with the idea that their UDPIs might not go together as often because their price action won't go together as often. You'll have layer ones pumping, then you'll have metaverse pumping at different times. They should be less correlated to each other than everything from within one sector. So that's why I chose these four. But I digress. What we're talking about is delving into this more. So what you can see is the moves that it's making. So it's taking a lot of profits into September. That's around here in September. Buying back in during that dip. But then as we rocket it off in October, starting to take profits again as we get into closer to November. And then reinvesting back into the market as we had the sell-offs going into December. And then we had some pumps that happened in kind of the last several weeks, kind of in January and before, taking profits on those. And now reinvesting back into the market. And we can see it also if we just look at the different assets here. So if we look, we can see a lot of profit being taken from Bitcoin early on as it kind of pumped up a lot. So that's what's happening here. But then buying back in as Bitcoin dipped down again. And then selling out of Bitcoin again as it pumped into November. And then moving those profits elsewhere. So the red here is Atom. So again, Atom as it pumped in going into September, taking a lot of profits off of there. and then reinvesting in later as it goes over here and it was lower at a lower risk point, and then taking profits off of it again once it really pumped in the more recent history. Engine Coin had some nice moves to the upside that then got sold off, and it's kind of been trading in and out of Engine Coin. You can see taking some profits kind of in and out was happening in this simulation. And then with Helium, again, Helium had a big pump here, sold that off to take these profits, bought back in, and then Helium actually has to have another pump here, which then got sold off, but then actually reinvested as Helium has now gone to lower profit. So it's a little bit difficult to see exactly what was going on under the hood with the switching between the different assets, but you can get some sense by looking at these different lines of where profits were being taken from one, and then building up of a position, and then taking profits off of it again once that position rallied to multiples above where it was bought in at. And really what that ended up doing, with I think is really fascinating, if you look at the profile of this white line, is this is where the market peaked. Back here in November. This is the top of the actual crypto market right here. But you'll notice that the white line, the top of this DCA strategy, was actually all the way into January. In a downward trending market, in a downward trending crypto market, this actually made money over that period, this weighted DCA strategy. And I think that's remarkable. And the reason for it, again, is because certain assets will pump at weird times. Certain assets will pump at times that other ones aren't. And when that happens, and you're able to identify those low-risk assets, have a position that you've moved profits into, and then ride that up, that can let you make profits even in a downtrend. So I think Helium and Atom Cosmos are probably the most responsible for this, where like Atom, for example, had a nice rally recently. It's kind of cooling off from that now, but had a really nice pump up back several weeks ago, and so that's probably feeding into this here, that as Atom had that pump, UDPI updated, getting to higher risk zones, and then profits were taken off of it, and then ultimately now reinvested. And so that is one of the usefulnesses of this, is just that because you're trading in and out of different assets, you can take profits off the ones that are unlikely to keep going up, invest that in the ones that are lower risk, that have more upside potential, and then capture that upside potential when it happens. And so you can see that really this white line's been flat ever since about November, whereas the market overall has been way down over that time. And so this person's kind of been insulated against some of that downside. And that also was helped by having so much cash on hand for a lot of it as well before going all the way to the bottom. So to put some absolute numbers on it, weighted DCA total $126,000 plus change. Buy and hold a little bit lower than 60,000. So this is over a doubling of your money using this weighted DCA strategy versus the buy and hold. And remember, this is just looking at 4 assets. This is just looking at 4 different assets. There's nothing to say, this is a proof of concept, right? This is just showing the power of this kind of approach, how it can help to squeeze more profits out of these bull markets that we find ourselves in. Realistically, anyone doing this might be looking at tens of these different ones, dozens of these different UDPI indicators. Here on the channel, we have over 25 different UDPIs that we're monitoring in real time. And so the idea is that, using kind of this dynamic approach, it helps to identify those ones that are really high risk, identify the ones that are really, really low risk, and then move things dynamically between them. So this is just one possible combination. There'll be any number of other combinations, ones that are larger, etc., that could help potentially even compound these profits even more, kind of really make sure that the money's going into the lower risk or higher upside assets when reinvestment seems prudent. So that's just what I wanted to show today, is the efficacy of these multiple UDPI strategies. And this is something we've talked about since the beginning of this channel. This idea that the real benefit of these risk indicators is not just to know if one asset is high or low risk, but to have it for multiple different assets at the same time, because it allows you to identify these opportunities. When one asset's high risk, when another asset's low risk, and you're in the middle of a bull market, that can be an opportunity to take profit off the high, move into the low, compound the profits. Now, I want to say at the end here, none of this is financial advice. You should form your own opinions, form your own strategies. Don't take this as gospel, do your own research. But this is what I personally view as being the power of risk indicators, especially when you have many of them, because you can identify those opportunities, compound profits, and it lets you use, pretty relatively safe crypto coins. You don't need to go to super low cap, meme coins to make good profits. You can compound your profits on just even these, bigger name assets and still do very well for yourself without taking all that downside risk that would come from one of those really low cap assets that might not go anywhere, could implode. And so that's why I really like this approach personally, is that it lets you maximize upside while in a way kind of having a better risk-adjusted return. You're not having to go so far down the risk curve to make higher returns. You're able to really squeeze out the returns that you can get on these kind of more blue chip type of assets. So that's just another thing I want to mention that I think is really cool about this approach. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI, and especially with multiple UDPIs, we're all going to make it.